Hey everyone, and welcome back. Today we're diving into a question that's probably crossed all of our minds at some point, especially with how crazy interest rates have been lately.
Oh, tell me about it.
Are you thinking about refinancing your mortgage?
It's a big one, right?
Huge. And with all the news about rising and falling rates, it's enough to make anyone's head spin.
Yeah, it's easy to get analysis paralysis for sure.
For real. Well, a recent Reuters article really caught my eye because it highlighted just how many people are actually taking the plunge refinance applications. Apparently jumped a massive 20% in just 1 week.
Wow, that's a lot of people hoping to snag a lower rate.
Right, so clearly this is something that's on a lot of homeowners' minds.
Makes sense. Even a small change in interest rates can add up to some big savings over the life of a loan, especially when we're talking about mortgages, which are, well,
Not exactly small potatoes.
exactly.
The article did mention that while the average rate on a 30-year fixed-rate mortgage has come down to 6.4%.
Which sounds pretty good on the surface, yeah.
Right, until you think back to, like, a year or two ago when rates were, half that.
Yeah, it really puts things in perspective.
So how do you even know if a refinance would actually be worth it for you? I mean, it's not just about whatever the current average rate is, right?
Definitely not. It's all relative to what your current rate is, how long you plan to stay in your home, and what your overall financial goals are.
It's like everyone's situation is different.
Exactly. Like this Reuters article quoted Matt Vernon, who's the head of consumer lending at Bank of America.
Okay, and what does he have to say?
He suggests that aiming for at least a 1-2% rate reduction is a good starting point.
A full 1 to 2% lower. Interesting.
Yeah. And he makes a good point because when you refinance, you're not exactly doing it for free.
Tell me about it. Closing costs are the worst.
The worst. You've got all those fees, appraisal fees, origination fees, you name it. It seems like they can easily add up to a few $1,000s.
Oh, easily. It's like, why does it have to be so expensive to just, change your loan?
Right. It's like, can't we just, wave a magic wand and make it happen?
If only. But okay, so even if you do find a lower rate, you have to factor in those closing costs. So how do you know when those savings will actually outweigh those initial expenses?
Right. That's the million-dollar question. You need to figure out your break-even point, which is basically how long it will take for those monthly savings to make up for the upfront costs of refinancing.
So, are you saving enough each month to justify those costs in a reasonable amount of time?
Exactly. It's a bit of a balancing act, for sure.
And what if you're thinking about selling your home in the near future? I mean, does it even make sense to refinance them?
That's a really good point. If you're planning on moving soon, refinancing might not be worth it. You really need to think about how long you plan to stay put.
Because if you're only staying for, another year or two, you might not even break even, right?
Exactly. You might end up paying more in closing costs than you actually save in interest over that short period.
Okay, that makes sense. So it's definitely not a one-size-fits-all situation. You really have to consider your individual circumstances and, like you said, what your overall financial goals are.
Absolutely. Refinancing can be a powerful tool, but like any tool, it's important to use it strategically and at the right time.
So how do we even begin to figure out what the right time is? Is there a crystal ball we can consult?
I wish. Unfortunately, timing the market, whether we're talking about the stock market or interest rates, is always a gamble.
Ugh, don't I know it.
This article actually mentions Daryl Fairweather, who's the chief economist for Redfin. She actually compares trying to predict the absolute lowest point for interest rates to, trying to time the stock market.
That's a scary thought.
Right. You could wait forever for that perfect dip and miss out on some serious savings in the meantime. Or, even worse, rates could jump back up while you're still waiting.
Okay, so what you're saying is that it's not as simple as just waiting for the absolute lowest rate possible. There are other things to consider, right?
Exactly. It's about weighing the potential for slightly better rates against the potential savings you could be locking in right now.
So don't get too caught up in the waiting game, or you might just miss the boat entirely.
Exactly.
So it's about finding that sweet spot, not getting too caught up in trying to time the market perfectly, but also not rushing into something without considering all the angles.
Right, because like we said, refinancing isn't just about snagging a lower interest rate. There are other factors at play here.
Okay, so let's break it down. What else do we need to be thinking about besides the rate itself?
Well, we've talked about the interest rate, but there's another key player in this game, the length of your loan.
You mean how many years you have left on your mortgage?
Exactly. It's called the loan term. So let's say you originally got a 30-year fixed-rate mortgage.
Which seems pretty standard, right?
It's a popular option.
Yeah.
Now you could refinance into a new 30-year loan with that lower interest rate we talked about, or You could actually look into shortening your loan term. Maybe go for a 15-year loan instead.
Whoa, that sounds intense, like cutting your mortgage in half.
It can be a game changer, though. Think
Oh,
about it. A shorter term means you're paying less interest overall, and you get to be mortgage-free sooner.
okay, that part sounds pretty amazing, but what about those monthly payments? Wouldn't they skyrocket if you switched to a 15-year term?
You're right. A 15-year loan will typically come with a higher monthly payment, even if the interest rate is lower. It's because you're squeezing those payments into a shorter time frame. You're paying off the principal balance faster.
So basically, you're trading lower monthly payments for a longer period of time with higher monthly payments for a shorter period of time.
Exactly. But here's the thing. Even though those monthly payments might be higher in the short term, you could end up saving a ton of money in interest over the life of the loan.
Really? Like, how much are we talking here?
It can be significant. Just to give you an idea, let's say you have a $300,000 mortgage at a 6% interest rate on a 30-year term. Your monthly payment would be around $1,800, right?
Sounds about right, yeah.
Okay. Over those 30 years, you'd end up paying over $348,000 just in interest.
Whoa, seriously, that's insane.
Right. It's wild how much it adds up over time. But now let's say you refinance that same $300,000 loan into a 15-year loan, even with a slightly lower interest rate, let's say 5.5%.
Okay, so a lower rate, but a shorter time frame. Got it.
Exactly. Now, your monthly payments on that 15-year loan would be higher around $2,530.
Okay, so more each month, but you're also done paying it off way sooner.
Exactly. And because you're paying it down faster, you'd only end up paying about $155,000 in total interest.
Wait, so you're saying that by choosing the shorter loan term, you could potentially save almost $200,000 in interest payments?
You got it. It's all about that long-term perspective. And of course, being mortgage-free sooner is a huge financial win in my book.
Who doesn't love the idea of getting rid of their mortgage payment ASAP? But realistically, that higher monthly payment isn't feasible for everyone.
Right. Affordability is key. It's a trade-off. You need to weigh the benefits of faster equity building and long-term savings against your current budget and financial comfort level.
It's about finding that balance, like with most things in personal finance.
Exactly. But, speaking of financial wins, there are other ways to leverage your home equity besides just shortening your loan term. Have you ever thought about a cash-out refi? Especially with how much home values have increased recently. Like the S&P CoreLogic Case-Shiller Index has been showing those record-high home prices. It makes you wonder. It's definitely something to think about. It can be tempting to think about, right? Especially if we've got some big plans or expenses on the horizon.
Like, hello, dream kitchen renovation. But seriously, it's a big decision. So for those of us who might not be familiar with the ins and outs, what exactly is a cash-out refinance?
So basically, it lets you tap into the equity you've built up in your home and get some of that money in hand. It's like you're refinancing your existing mortgage for a larger amount than what you currently owe, and you get the difference in cash.
Okay, so you're essentially taking out a new, bigger mortgage, but with today's hopefully lower interest rates and pocketing the difference.
Exactly. And that cash can be used for a variety of things. Like you said, home improvements, debt consolidation, maybe even investing. It's really up to you.
Sounds like a pretty sweet deal if you need access to a chunk of cash.
It can be, but, and this is a big but, it's crucial to remember that you are increasing your overall debt.
Right, because you're taking out a larger loan amount.
Exactly. So even if you snag a lower interest rate, which is one of the main perks of refinancing, those monthly payments could still increase if you borrow a significant amount.
Okay, so it's not just about the interest rate, it's about the total amount you're borrowing and how that affects your monthly cash flow. Got it. So let's say someone's listening and thinking, all right, I've laid all my options and I'm ready to explore this whole refinancing thing. Where do they even start? Is it as simple as calling up their current mortgage lender?
That's a great question. And honestly, it's something that a lot of people overlook. It might be tempting to just stick with your current lender, but remember that expert advice we were talking about. Daryl Fairweather from Redfin made a really good point in that Reuters article. She basically said, don't be afraid to shop around.
Okay, so it's not disloyal to your current lender to see what else is out there.
Not at all. There are so many lenders out there, banks, credit unions, online lenders. They all have different rates and terms. You really owe it to yourself to compare and see what you can qualify for.
That makes sense. But who has time to be calling up a million different lenders? It sounds exhausting.
That's the beauty of living in the digital age. We've got all these amazing online tools now that make comparison shopping for mortgages so much easier.
Like what? Give us the good stuff.
Oh, there are tons. LendingTree, NerdWallet, Bankrate. These platforms let you put in your information once and get quotes from multiple lenders. You can compare them side by side, see who's offering the best rates, what the fees look like. It takes a lot of the guesswork out of the process.
That sounds way less stressful than playing phone tag with a bunch of loan officers. This has been super informative. We've covered so much ground, from understanding why everyone's talking about refinancing and what those fluctuating interest rates really mean for your wallet, to exploring different strategies like adjusting your loan term or even doing a cash out refi.
It's been quite the deep dive.
Yeah.
But hey, that's what we're here for, right? To equip you with the knowledge to make those big financial decisions with confidence.
Absolutely. But before we wrap things up, I always like to leave our listeners with a little something to ponder. So here's a final thought as you navigate this whole refinance decision. Let's say, just for fun, that you decide not to refinance right now. What could you do with that extra money you'd be saving each month if you did refinance? Could you invest it? Pay off other debts faster? What would that look like for you? Just something to think about. Sometimes the best financial decisions come down to understanding the opportunity cost of each choice.
I love that. It's all about aligning your financial moves with your goals and values. Refinancing can be a fantastic tool for some, but it's not a one-size-fits-all solution. Weigh your options, crunch the numbers, and most importantly, don't be afraid to seek guidance from a trusted financial advisor if you need it.
Couldn't have said it better myself. Thanks for joining us for another deep dive. Until next time, stay curious, stay informed, and happy calculating.